Hello, we're going to show the output data from the B2T engine on the B tax, or the base erosion and anti-abuse tax in the US. We know that a company can shift its taxable income to foreign countries by deducting its expense payments to foreign countries. The B tax is a minimum tax mechanism to ensure that if a company's regular tax liability is too low due to those base erosion payments to foreign countries, the company would still have to pay a minimum level of tax. The B tax calculation involves adding back the base erosion payments to the company's regular taxable income, calculating the B tax expense, and comparing the amount against the company's regular tax after certain tax credit adjustments. The logic is less than straightforward, but the B2T engine will handle all that automatically, as long as the user maps its accounts to the standard accounts and provides the country information of the relevant foreign expense payments. Here, we're going to use a simple example to show the output data that are relevant to the B tax. So here's the input file of our simple example where we want to calculate tax for a US company P that has a revenue of $1,000. And in the input, we also tell the engine that there is an entity group, P group, where the parent company of the group is just a P company. And we first tell the engine that the P group has a tax obligation to calculate taxes for the whole group. Now, calculating taxes for a whole group would trigger the engine to automatically perform calculations of items of international taxation. However, the B tax calculation is an exception. It is not automatically included by the engine. This is because of the fact that for the B tax to be applied to a company, one of the conditions is that the company needs to have over $500 million revenue on average for the past 3 years. Now, since the B2T engine does not store any data of the company, it cannot decide on its own whether the B tax would be applicable or not. In this case, the user needs to explicitly tell the engine that the B tax is indeed applicable to the company P. And we'll do this by adding a property on the entity record for P. Here, we potentially could specify a bunch of properties for P, and one of them is USA beat is applicable, the flag property. So here we're going to add a property, USA beat underscore is applicable equal to true. Okay, so that's it. Then we're going to save it. And we're going to the recurring input sheet and send it to the B2T engine. So now it's down. Let's go to the output file, examine the B tax calculation data. So here's a calculation for the P on $1,000. It has a tax of $210. So nothing surprising here. So we go to the provision sheet for P and examine its actual calculation. And we start with the current tax engine, the current tax expense calculation for P. And we go down the special items. We look at the beat after tax. It is 0. So basically the engine says, in our simple case, there's really no beat tax at all. So why is that? So we go down to take a look at the beat calculation report. So we go down, this is the deferred tax rate rec report, an FTC report, Subpart F report, a guilty report, and here's our beat calculation. So The beat calculation first determine the base erosion payments, okay, which we did not tell the engine anything about it. So therefore, it is 0. Then the engine add back to the regular taxable income, which is 1,000, and add the base erosion payment, which is nothing. So the modified taxable income for P is still 1,000, and the beat rate is 10%. So the beat is $100. Now this is the minimum tax that the P has to pay. Okay. However, the regular tax of the P is 210, as we calculated earlier, because it's $1,000 at 21%. So we already know that. And in our case, we don't have any tax credit adjustment items at all. So the adjusted regular tax is 210, which is already more than the minimum tax. So therefore, the engine says, really, you have paid enough tax. There's no need to add additional tax of type B. So that's how the 0 is being obtained. Now, we haven't tell the engine anything about the expense side of P. So let's assume that P actually have some expense, and in particular, it has an expense from base erosion payments to a foreign country, let's say Canada. So let's see how the engine will handle that situation. So we close this output file. We don't save it. So here's we went back to our input file, and we want to tell the engine additional information about the company P. We have told it that it has a revenue of 1,000, but now we have expense information. So here they are. We tell the engine that in addition to $1,000 revenue, it has an expense account that's balance is 500. And further, it has another expense, which is a management fee expense of $400. And in particular, we tell the engine that the transaction counterparty is in a country, Canada. Now, Canada is foreign to United States. So this management fee is actually paying to a foreign country. So that is a base erosion payments. Okay, here now, of course, we have to tell the engine what exactly is this EXP and this fee expense account. So we're going to go to the setup input sheet, and we're going to add the account mapping records. So here are the account mapping records where we will tell the engine that the EXP account is really just an expense account. And this fee expense account is a management fee expense. So the engine knows the characteristics of those accounts. It knows what to do. So that's it. We're going to save it. And we're going to submit them. You go to the easy button and submit them. And it's down. So we're going to open the output file. Now we see the number is a little bit different now. It was 210, now it's 50. Why is that? So we go to the provision sheet, and we're going to start with the current tax expense calculation, and we go down, we see the beat, and the beat has a value of $29. Now, before the beat, there's a current tax expense before any credit or anything. It was $21, right? Remember, we have a $100 income because 1,000 we have 500 expense and 400 expense, so less than 900. So this is, in the income is only 100. At 21%, the tax is $21. So the engine essentially says, in addition to the regular current tax expense, you have to pay an additional B tax of $29. So why is that? So now let's go down to the BEAT calculation report. So we go down, and here's the FTC, subpart F, guilty. Now here's the BEAT calculation. So now we see the base erosion payments is $400, right? And it says, okay, why is that? So we go to the detailed calculation sheet following the shortcut arrow. Okay, so here's a detailed calculation sheet, and we see the USA BEAT calculation and see how those basic input data, the base erosion payments, the adjusted tax credits, and either adjusted or unadjusted if it's a tax credit, and deductible expense, and tax loss. So these are the information that we pick from, that each account will be contributing into the BEAT calculation. So the expense, the ending balance is 500. It contributes to the deductible expense. Makes sense, right? The management fee expense, it contributes the management fee. That account balance of 400, it contributes to base erosion, okay? And further, it is also a deductible expense, so it contributes to both. And here is the engine took the note over here, says that base erosion percentage to a foreign counterparty. It noticed that this payment is to a foreign country because the user have told the engine so on this trial balance record. Okay, so it noticed that. Then we aggregate the contribution from the account balances and aggregate the contribution from the book tax adjustments. That's in the end, we have the base erosion payments and deductible expense. That's how those numbers are coming from. So we go back to the BEAT calculation. So here's the base erosion payments and deductible expense. So it's really 44% of all the deduction is base erosion payments. That sounds big number. And if there were any tax loss, like if you take a net operating loss deduction, then a fraction of that would also be base erosion payments as well. We don't have anything here. So these are the base erosion payments, and you have a regular taxable income is 100, and base erosion payments is that we need to add back. Okay, add back. So the modified taxable income is 500. At 10%, you have the $50. So here the engine essentially says, because you have paid those base erosion payments, at a minimum, you have to pay $50. Okay. Now let's examine the other side. Your regular tax is $21, and we're not going to get into this adjustment of tax credit. So essentially, the adjusted regular tax for P is 21. Okay. So your regular tax is 21. It is less than the 50. So therefore, your BEAT has to be $29 to make the total 21 plus 29, make it up to the minimum tax of $50. So that's how this BEAT tax 29 is being calculated. So to summarize, the user really only needs to map his accounts to the standard account types, such as the management fee expense account, and he needs to specify any country information for the expense account balances of the base erosion payments. And remember, we told the engine that it was from Canada. Then the B2T engine will automatically perform the calculation for the B tax. That's it. Thanks for watching.